Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Tesla, the most expensive story ever told. This article was written by Attila Zambito. Summary. Pause. Tesla remains overvalued, with core automotive struggles and profits heavily reliant on declining regulatory credits. I reiterate a sell rating. Automotive deliveries and market share are falling, while competition intensifies and new model launches lag, challenging TSLA's growth narrative. Energy and services segments are growing rapidly, but remain too small to offset automotive and regulatory credit declines, and their growth rates may not be sustainable. The stock is detached from fundamentals and represents speculation rather than investment. I wrote my first article about Tesla, TSLA, last year in September, and argued that the company is priced to perfection, although the core business segment, automotive, is struggling, and most profits are from declining regulatory credits. The company released its full-year results on Wednesday. In my view, Tesla remains overvalued. The automotive business keeps struggling, and autonomous driving as well as Optimus remain future projects with no guarantee of paying off. I rate Tesla again as a sell. FY25, first year of declining revenues. The financial year 2025 was challenging for Tesla. It was the first year of declining revenue since the company began publishing its financials in 2010. The decline of 3% may not sound impressive. However, considering that Tesla is valued like a high-growth tech company, the decline is worrisome. Diving deeper into the segments, it becomes clear where the main issue lies. The largest segment, with a 73% revenue share, automotive, saw sales decline by 10% year over year. The picture gets even worse, as revenues for this segment already peaked in 2023 at $82.42 billion. Since then, revenues have declined by around 15%. Moreover, the company's full-year results could have even been worse without the expiry of the EV tax credit in the third quarter. The tax credit enabled customers to save up to $7,500 on the purchase of an EV. Customers who were about to purchase a car decided to do this earlier to still benefit from the EV credit. This makes total sense, considering that around 17% of a Model Y was subsidized. I'm not convinced that the expiry of the tax credit only front-loaded demand for the fourth quarter, but rather for several quarters. For example, those who plan to buy the car in 2026 could have bought it before September 30th, as the cars would get significantly more expensive afterwards. The argument that only fourth quarter customers purchased in the third quarter is too simplistic. The financial year 2025 was also the second year in a row of declining delivery numbers, which were down by around 9%. I will discuss the potential reasons for this later in this article. On the bright side, the other two segments saw very good growth. Energy generation and storage revenue increased by 27%, and service revenue by 19%. Moreover, as can be seen in the graphs below taken from the investor presentation for Q3, both segments are not only fast-growing, but also profitable. However, both currently have a revenue share of around 13%, which can only partly offset the declines in automotive sales and regulatory credits. Moreover, the law of large numbers makes me doubt that such growth rates can continue for long, especially considering that competition is catching up. In 2024, Tesla had a market share of 15% in the battery energy storage system market. Its biggest rival, Chinese Sungrow, is in second place with a 14% market share. The company has narrowed the gap to Tesla from 4 percentage points to just 1 percentage point within 1 year. But to be fair, Tesla is still the clear number one in North America. Tesla captures 39% of the market, compared to just 10% for Sungrow. Nevertheless, it is important to take competition seriously. Tesla also once was the clear number one player in the EV market, and has lost significant market share to competitors in recent years. Tesla's profitability has deteriorated in recent years. In 2022, the company generated $13.65 billion in operating profits. The $4.36 billion in operating profits for 2025 is only a third of the 2022 level. Moreover, Tesla was seen for a couple of years as a superior automotive business, because of higher margins than its peers. I compared Tesla's margins with a legacy car manufacturing company, Mercedes-Benz, and gross margins are around 16.5%, and operating margins around 5%. This is almost the same as for Tesla. Nevertheless, the market value of Tesla is more than 25 times that of Mercedes-Benz, and Mercedes has higher revenues than Tesla. In my last article, I already shared my pessimistic view on regulatory credits. I believe that those revenues will decline in the coming years, and that they help Tesla achieve profitability when its core business was not yet profitable. In 2024, roughly 40% of Tesla's net income came from these credits, which are essentially 100% margin. In 2025, roughly 52% of Tesla's net income came from regulatory credits. Without around $2 billion in regulatory credit revenue, the net income wouldn't be at $3.8 billion, but at $1.8 billion for 2025. An adjusted net income of $1.8 billion results in a PE of 822. William Blair projects that regulatory credit revenue for Tesla will decline to $595 million in 2026 and hit zero in 2027. I agree with William Blair's view, as I don't believe that Trump is likely to continue supporting regulatory credits. Moreover, legacy automakers are accelerating their transition to electric vehicles, which reduces demand for EV credits. In my view, Tesla has not shown any sign of recovery this year. What I personally find most concerning is that the gap between Tesla and legacy car manufacturers seems to be narrowing, which goes directly against the argument that Tesla's automotive business is superior. I expect 2026 to remain challenging, and it is yet to be seen if the automotive segment can stabilize. Moreover, I believe that regulatory credits will decline and pressure the bottom line. The automotive segment. I did my semester abroad in Oslo and used Uber when I was in the middle of nowhere. What picked me up? A Tesla, I think a Model 3. It was my first time in a Tesla, and honestly, I wasn't that impressed. In my view, the build quality appeared poor compared to German cars. For example, seams and panel gaps were inconsistent. I know that this is subjective, and that characteristics such as speed and software also play a role. I also like the simplistic and futuristic interior design. Nevertheless, this was my first and honest impression. Tesla's market share dropped further to around 41%. A market share that high still sounds impressive, but taking a closer look, the market share declined from 75% in the US in the first quarter of 2022. This clearly shows that the EV market has become more crowded, and Tesla has lost some ground. Furthermore, I have not seen any sign of stabilization or recovery yet. There are mainly two reasons for this. First, Tesla has not launched a new model since the Cybertruck in 2023. The other four models, 3, Y, S, and X, were released years ago and have seen smaller updates throughout the years. The new version of the Model Y, called Juniper, offers an updated interior, performance, and design. On the one hand, this could attract new customers. On the other hand, I'm not sure if such improvements will have a high enough impact. Moreover, there are rumors about a second-generation Tesla Roadster in 2026, and I think the car looks pretty cool. Nevertheless, Elon Musk has often overpromised in the past, and I have my doubts about the ambitious target to ramp up production this year. I believe the Roadster will arrive in maybe 2 to 3 years. Another rumor concerns the $25,000 Model 2. This would be competitive with BYD's more affordable EVs. However, Musk has already promised the Model 2 since 2020. I agree with the 2026 Consumer Report that these small changes make Tesla cars more reliable. However, I believe that the company needs to create more excitement around its products. Tesla could do that by releasing a new, more affordable version of its existing models or a completely new model. Second, competition has heated. As I already described, Tesla was dominating the EV market in 2022. During that time, I often read that other car manufacturers such as Mercedes-Benz, BYD, BMW, and others would never be able to effectively compete with Tesla. Just 4 years later, Tesla's market share is cut in half. Moreover, BYD has officially overtaken Tesla as the world's largest seller of electric vehicles. One reason is the affordability. BYD's entry-level model sells in China for just under $10,000. Tesla's Model 3 is its cheapest vehicle, but costs roughly 3 times more than BYD's $10,000 car. Moreover, I don't know a single automobile company that does not have an EV range or is not currently developing one. In my view, competition won't get less in the future. Companies such as BYD offer more affordable EVs with higher build quality. Tesla is still leading in software and performance. Nevertheless, competition seems to be catching up. Cybercap and autonomous driving. I would be naive to assume that Tesla's market cap of $1.5 trillion is only about automotive. It wouldn't make sense for a struggling car manufacturer to trade at 15 times sales and a forward PE of 267.21. Management has successfully built new narratives around the company. Tesla is not valued like an automotive business. It is a software company, an energy company, and it will build autonomous driving vehicles and be an industry leader in humanoid robotics, according to some bulls. I want to understand this narrative, as it seems to drive Tesla's valuation, and will therefore focus on full self-driving again. Those who want humanoid robotics can find this in my last article about Tesla. According to McKinsey, autonomous vehicles have the potential to profoundly transform mobility. Autonomous vehicles can be used for private vehicles, robotaxis, goods transportation, robotics, and more. The market potential is huge, and the consulting firm expects the market to be between $300 and $400 billion in 2035. This assumes that 48% of consumers globally would use autonomous taxi and shuttle services. I'm always very cautious when the TAM appears that massive. First, McKinsey didn't explain what led to this assumption. Moreover, I believe assuming that within less than 10 years, half the population worldwide will use autonomous vehicles is quite optimistic. Additionally, I found various different predictions during my research. In my last article, I talked about Grandview Research predicting the market in the US to reach $43.76 billion by 2030. Precedence Research estimates it to be $189 billion. If we apply a 15% profit margin for Tesla, and the company captures 30% of the market, each study will result in completely different revenues and profit figures. If we take the numbers from the McKinsey study, Tesla would generate around $90 to $120 billion in revenues and $13.5 billion to $18 billion in profits by 2035. The predictions of the Grandview Research study result in Tesla generating $2 billion in additional net income by 2030. And the Precedence Research study implies a revenue potential of $56.7 billion and profits of $8.5 billion by 2030. This illustrates perfectly how different TAM predictions can lead to different optimistic profit expectations for Tesla. I see another issue with the technology Tesla uses. Elon Musk decided that Tesla would focus on a vision-only system for FSD. His reasoning was that humans also drive with their two eyes on the road. Using vision only requires cameras, not expensive sensors, radars, and other technology. Cheaper cars make it easier for Tesla to scale. The Cybercab is estimated to cost between $20,000 and $25,000. Waymo, on the other hand, could have a final cost of $75,000. Now, a fully equipped vehicle costs around $150,000. However, do customers really want to ride in a robotaxi that may be cheap but unsafe? The technology, such as LiDAR, which Waymo is using, is active rather than passive. Therefore, it is able to see through certain things that cameras simply can't. For example, Tesla's FSD has difficulties distinguishing between a billboard and the sky, or between crossing trucks. Moreover, Tesla's FSD is still at level 2, which means it requires a human supervisor. Another indicator that Tesla still has a long way to go is the accident rate, which is the highest of any auto brand. Honestly, I don't think it is possible to reliably estimate the revenues and cash flows of a business or industry that does not yet really exist. Any attempt would be little more than a wild guess regarding margins, market size, or adoption. The way the market prices these innovations as if they will happen with certainty is what makes me bearish. Valuation. The perhaps most challenging part of valuing Tesla is the combination of a declining business, a growing business, and a currently non-existent but potentially promising business. In my last article, I also did a sum of parts analysis for those who are interested, but I want to keep it simple this time with a DCF. I prefer to take a conservative approach avoiding overly optimistic assumptions that could make the business appear undervalued when it actually isn't. To project future cash flows, I use the FCF margin multiplied by projected growing revenue. This year, the FCF margin is expected to be 6%, which I also use as my base case assumption. The 6-year average was 6.67%, and the median was 6.65%. My discount rate of 9% reflects my opportunity cost. I account for risk not by adjusting the discount rate, but by applying a margin of safety. The more uncertain I consider a business, the higher the margin of safety I require. For Tesla, I would prefer a margin of safety of at least 35%. Given the cyclicality of the automobile industry, the risk of losing market share to competitors, brand damage, and the fading regulatory credit revenue. These are the primary sources of uncertainty. Nevertheless, Tesla has a healthy balance sheet and has repeatedly demonstrated its ability to turn the business around and withstand hardship. To estimate the terminal value, I use the long-term GDP growth rate plus inflation, which I assume to be 2.5%. Just to be clear, I am being generous in this DCF model. I do not assume further deterioration of Tesla's EV business in the mid-case scenario, and I still assume 40% annual revenue growth for the energy segment. On average, I assume overall revenue growth of 15% after stagnation in 2026. In my mid-case scenario, the fair value is $34.45 per share, significantly below the current $437. In my bad-case scenario, the FCF margin drops to 3% because of tariffs, intensifying competition, and higher CapEx and R&D spent to stay competitive. And this would result in a fair value of $17.22 per share. The interesting part is to determine the growth rate necessary to justify the current valuation. If revenue grows on average by 50% after a flat year in 2026, the fair value in my bad case and mid-case scenarios rises to $44.87 and $89.75. Even then, the current stock price of $437 is far above the fair value. To justify the current market cap, Tesla's revenues would need to grow at an average annual rate of 50%, and the FCF margin would have to be 5 times higher than it currently is, and all of that just to justify the current stock price. Risks. First, the automobile business could recover significantly with the release of the updated version of the Model Y, the second-generation Tesla Roadster, other updates on models, or completely new products. If Tesla were to manage to build a car that costs only $25,000, this would increase competitiveness and maybe help the company regain market share. Secondly, Tesla could become the leader in robotics and full self-driving. If this happens, and the overall TAM increases, as well as if there are more use cases for robots, this could be a significant win for Tesla as a company. However, at current prices, the narrative is, in my view, already fully reflected in the share price. I believe that Tesla will be a very interesting case study decades from now. Maybe people will talk about how Tesla has become the greatest company of all time, or how retail investors were fooled for years by narratives and didn't manage to get out before the house of cards collapsed. I don't believe that anyone can reliably value technological development at such an early stage. I certainly cannot. Who knows how large the robo...
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.